Success isn't an accident. It's a series of smart choices, calculated risks, and relentless learning. In today's video, we're breaking down some of the most powerful business strategies that can help you get ahead. If you're serious about growth, subscribe, hit like, and turn on notifications to stay ahead of the curve. And tell us, what's the biggest business lesson you've learned so far? Let's discuss.
Investing in real estate has numerous benefits that make it an attractive option for building wealth and ensuring financial stability. Whether you are a seasoned investor or just starting out, real estate can provide opportunities for steady income, asset appreciation, and diversification. Real estate investing can be a lucrative venture, but it requires careful consideration of both pros and cons. Deciding whether it's right for you involves evaluating your financial goals, risk tolerance, and lifestyle. First, understanding your goals and strategy is crucial. If your goal is generating income, rental real estate can provide a steady stream. Real estate can also appreciate in value over time, leading to potential capital gains. Additionally, adding real estate to your investment portfolio offers diversification. Various strategies exist, including buying and holding properties to rent out for long-term growth, flipping properties by buying low, renovating, and selling for profit, or investing in real estate investment trusts, REITs, for a less hands-on approach. Financial considerations include initial costs, such as a down payment, typically around 20% for investment properties, closing costs, and renovation expenses. Ongoing expenses encompass mortgage payments, property taxes, maintenance, insurance, and property management fees if you choose to hire a company. Conducting market research is essential. When choosing a location, consider factors like growth potential, economic conditions, and rental market demand. Different types of real estate, such as single-family homes, condominiums, apartment buildings, commercial properties, and specialty properties like vacation rentals, each have unique considerations. Assessing risks is another critical step. Market risks include economic downturns and interest rate changes, while property-specific risks involve potential vacancies and unanticipated repair costs. Legal risks encompass tenant disputes and changes in local rental laws or tax regulations. Regarding stewardship, you must decide whether to manage properties yourself or hire a property management company. Self-management offers direct control, but can be time-consuming and requires knowledge of landlord-tenant laws. Professional management, on the other hand, involves fees, but alleviates the daily operational burden. Tax implications include deductions for mortgage interest, property depreciation, and operating expenses. Capital gains taxes differ based on whether the property is held short-term or long-term, with long-term gains typically taxed at a lower rate. Personal eligibility factors play a role as well. Consider whether you have the time to manage properties or oversee renovations, if your financial situation is stable enough to handle unexpected expenses or market downturns, and if your risk tolerance can withstand potential vacancies, market fluctuations, and legal issues. The real estate search and evaluation process involves using real estate agents, online platforms, and auctions to find properties. Conduct thorough inspections, assess conditions, review financial records, and analyze comparable properties to ensure a sound investment. Cash flow analysis helps determine if a property will generate positive cash flow by evaluating income versus expenses. Steps to get started include evaluating your finances to ensure a solid foundation, studying markets to identify potential locations and property types, creating a team of professionals like real estate agents, mortgage brokers, and property managers, securing financing with pre-approval for mortgage loans, and starting small to gain experience. Real estate is attractive because it is tangible, providing a sense of security. It often appreciates in value over time, offering significant capital gains potential. However, real estate markets can be cyclical, and understanding market trends is crucial. Rental properties generate regular income, offering financial stability and potentially replacing traditional job income. Leverage, using borrowed money to increase investment potential, can magnify gains but also increase losses if property values or rental income decline. Challenges and risks in real estate investment include high upfront costs, ongoing expenses, market risks, liquidity issues, and the need for thorough research and due diligence. Expert strategies, such as Ken McElroy's focus on multifamily properties and cash flow, Robert Kiyosaki's emphasis on financial education and passive income, and Grant Cardone's strategies for large multifamily investments and cash flow generation provide valuable insights. Ultimately, real estate investing can be a powerful way to build wealth, generate income, and achieve financial independence. It requires a long-term perspective, thorough research, effective management, and a willingness to learn and adapt. By carefully evaluating your options and developing a solid investment strategy, you can navigate the complexities of the real estate market and succeed in this dynamic field. Steps to get started. 1. Evaluate your finances. Make sure you have a solid financial foundation. 2. Study the markets. Identify prospective locations and types of real estate. 3. Create a team. Find a real estate agent, mortgage broker, and property manager. 4. Secure financing. Explore mortgage loan options and get pre-approved. 5. Start small. Consider starting with a smaller investment to gain experience. What's attractive about real estate? Why it's worth considering? One of the most compelling reasons people are attracted to real estate is its tangibility. Unlike stocks or bonds, real estate is something you can see, touch, and use. This physical presence often provides a sense of security that other investments lack. In addition, real estate often appreciates in value over time, giving investors the opportunity for significant capital gains. Creating wealth through appreciation in value. When you buy real estate, whether it's a single-family home, an apartment building, or a commercial property, you're purchasing an asset that has the potential to increase in value over the years. This appreciation in value is one of the primary ways that real estate investors build their wealth. Historical data shows that on average, real estate has risen in value faster than inflation, making it a solid hedge against the rising cost of living. However, it's important to remember that real estate markets can be cyclical. While long-term trends are usually upward, you may experience periods of stagnation or even decline. This is where Kiyosaki's financial education tips come to the rescue. By understanding market trends, economic indicators, and the factors that determine real estate values, you will be able to make more informed decisions and better navigate periods of market ups and downs. Generating income through rental properties. Another significant advantage of investing in real estate is the ability to generate rental income. Owning a rental property means that you can receive regular, often predictable income from tenants. This income can help cover mortgage payments, property taxes, maintenance costs, and more, ideally leaving you with a positive cash flow. This recurring income is especially attractive because it can provide financial stability and, in some cases, even replace traditional job income. To maximize rental income, it's important to understand the market and set competitive rental rates, maintain the property in order to attract and retain tenants, and manage expenses effectively. Leverage. Leveraging other people's money. Real estate investing provides a unique opportunity to use other people's money to grow your wealth. By taking out a mortgage loan, you can control a larger asset with a relatively small initial investment. For example, a 20% down payment would allow you to purchase a property worth 5 times that amount. If the property appreciates in value or generates significant rental income, your return on investment, ROI, could be significantly higher than if you had invested the same amount in stocks or bonds without leverage. However, leverage is a double-edged sword. While it can increase your gains, it can also increase your losses. If property values drop or rental income declines, you could find yourself struggling to pay your mortgage and cover your other expenses. That's why leverage should be approached with caution, and you should make sure you have a solid financial cushion and emergency plans in case of unforeseen circumstances. The challenges and risks of real estate investment. While the potential benefits of real estate investing are significant, it is not without challenges and risks. Understanding this is essential to make informed decisions and manage your investment effectively. High upfront costs. One of the most significant barriers to real estate investment is high initial costs. Purchasing real estate typically requires a significant down payment, closing costs, and often repair or maintenance costs. These initial costs can be daunting, especially for first-time investors. It's important to have a clear budget and financing plan in place to make sure you can afford the initial investment without becoming financially overwhelmed. Ongoing expenses. Once you have purchased a property, there are ongoing expenses to consider. These include mortgage payments, property taxes, insurance, maintenance, repairs, and property management fees if you choose to hire a professional to manage the property. These expenses can add up quickly, and if not monitored, they can wipe out your profits. Market risks. As stated earlier, real estate markets can be cyclical and property value can fluctuate. Economic downturns, changes in the local market, or demographic trends can all affect the value of your property and your ability to generate rental income. Diversifying your investment portfolio and staying informed of market trends can help mitigate some of these risks. Liquidity issues. Real estate is not a liquid asset. Unlike stocks or bonds, which can be sold relatively quickly and easily, selling real estate can take time. The lack of liquidity can be a significant disadvantage if you need to access capital quickly. It is important to have a diversified investment portfolio that includes more liquid assets to ensure you have access to cash when needed. Applying key takeaways from experts. 1. Ken McElroy's real estate investing philosophy. 1. Focus on multifamily real estate. Why multifamily real estate? Cash flow. McElroy emphasizes that multifamily properties provide stable and reliable cash flow through rental income. They are less volatile than single-family homes because risk is spread across multiple units. Economies of scale. Managing multiple properties under one roof reduces unit costs and improves operational efficiency. Demand. Demand for rental housing is often very high, providing an opportunity for permanent occupancy and income generation. 2. Importance of cash flow. Positive cash flow. McElroy emphasizes the importance of investing in properties that generate positive cash flow from day one. This means that rental income should cover all expenses and provide a profit. Financial stability. Cash flow is critical to maintaining an investment during an economic downturn or market fluctuations. It helps cover mortgage payments, maintenance, and other expenses. 3. Due diligence. Thorough analysis. Market research. McElroy advises conducting a comprehensive market study to understand local economic conditions, job growth, and demographic trends. This will help identify areas with high rental demand and potential for increased property values. Property valuation. Evaluate the property's physical condition, financial performance, and potential for improvement. Analyze income and expense reports, occupancy rates, and comparable market indicators. 4. Value enhancement strategies. Value enhancement. Renovation. McElroy advocates strategic renovations and upgrades to increase property values and rental income. This may include modernizing apartments, improving common areas, or adding amenities. Operational improvements. Optimizing property management, cutting costs, and streamlining rental strategies can improve property efficiency and profitability. 5. Leverage and financing. Leverage. Financing options. Leverage can increase returns by allowing investors to control more real estate with less capital. McElroy recommends using conservative leverage to minimize risk. Interest rates. Keep an eye on interest rates and look for favorable loan terms. Fixed-rate loans can provide stability, while variable rates may offer lower upfront costs but carry more risk. 6. Long-term investment horizon. Patience and growth. Holding period. McElroy typically advocates a long-term strategy of owning real estate, allowing it to appreciate in value and generate rental income over time. Market cycles. Understanding real estate. Market cycles helps determine when to buy and sell, and taking a long-term perspective helps counteract short-term market fluctuations. The key elements of Robert Kiyosaki's real estate strategy. 1. Financial education. Understanding money. Financial literacy. Kiyosaki emphasizes the importance of financial education. He believes that understanding how money works is critical to making smart investment decisions. Shift in mindset. He encourages a shift from an employee mindset, working for money, to an investor mindset, making money work for you. Key concepts. Assets versus liabilities. Assets generate income and liabilities generate expenses. Kiyosaki advocates investing in assets that generate cash flow. Financial statements. Understanding and analyzing financial statements is critical to evaluating investment opportunities. 2. Passive income. Cash flow orientation. Income streams. Kiyosaki's strategy prioritizes generating multiple streams of passive income through real estate. This includes rental income and gains from real estate appreciation. 3. Debt leverage. Good debt versus bad debt. Kiyosaki distinguishes between good debt, used to acquire income-producing assets, and bad debt, used to pay off liabilities. He advocates using good debt to finance real estate investments. Leverage. Using leverage to purchase real estate can increase returns. Kiyosaki believes that proper leverage allows investors to control more real estate and increase cash flow without using significant personal capital. 4. Diversification and hedging. Diversified portfolio. Different types of real estate. Kiyosaki advises diversifying across different types of real estate to spread risk. Geographic diversification. Investing in different markets helps reduce the risk of local economic downturns. Hedging against inflation. Real estate is often seen as a hedge against inflation because real estate values and rental income typically rise with inflation. 5. Market cycles and timing. Understanding cycles. Market timing. Kiyosaki emphasizes the importance of understanding real estate market cycles and timing your investments to buy at low levels and sell at high levels. Keep an eye on economic indicators such as interest rates, employment data, and housing supply to make informed investment decisions. The key elements of Grant Cardone's real estate strategy. 1. Focus on multifamily real estate. Scale and efficiency. Cardone believes that multifamily properties, over 100 units, provide economies of scale, which makes management more efficient and reduces costs per unit. Consistent demand. Multifamily housing targets a broad demographic, which provides consistent demand and minimizes vacancy risks. Cash flow. Large properties generate significant cash flow that can support debt payments and provide significant yields. Typical investments. Class B and C properties. Cardone often selects Class B and C properties in growing markets. These are older properties that can be improved but are located in reliable middle-income neighborhoods. Value enhancement potential. Look for properties with improvement and performance potential that can increase cash flow and property value. 2. Cash flow and income. Income generation. Positive cash flow. Cardone emphasizes the importance of investing in real estate that generates significant positive cash flow. He favors investments where rental income exceeds all operating expenses and debt service. Reinvestment. He recommends reinvesting cash flow into new properties to continue to grow the portfolio and increase total returns. Evaluate a property based on its ability to generate consistent cash flow by considering current and potential rental income, operating expenses, and financing costs. 3. Value creation strategy. Real estate improvements. Renovations. Cardone looks for properties that can be improved through renovations and upgrades, such as modernizing facilities, improving the appearance, and adding amenities. Operational improvements. Focuses on improving property management to reduce costs, increase efficiency, and meet tenant needs. Strategic modernization. Rent increase. Improvements should allow for higher rents and increased income from the property. Tenant retention. Improve tenant amenities and satisfaction to reduce tenant turnover and vacancy rates. 4. Market selection. Growth markets with strong economic indicators such as job growth, population growth, and a business-friendly environment. Labor market. Areas with an active labor market tend to have a higher demand for rental properties. Population growth. Markets with growing populations often have higher demand for housing. 5. Long-term investment horizon. Buy and hold strategy. Long-term ownership. Cardone prefers to hold real estate for the long term to benefit from steady cash flow and potential appreciation in value. Tax advantage. He utilizes real estate-related tax benefits, such as depreciation, to increase returns and reduce taxable income. Patience and growth. Market choice. While Cardone may buy on circumstance, His focus is on long-term value and income generation rather than quick deals. Is real estate investing right for you? Investing in real estate can be a powerful way to build wealth, generate income, and achieve financial independence. However, it is not without its challenges and risks. By carefully weighing the pros and cons, educating yourself, and listening to expert advice, you will be able to make informed decisions and navigate the complexities of the real estate market. Remember, successful real estate investing requires a long-term perspective, thorough research, effective management, and a willingness to learn and adapt. Whether you are a sophisticated investor or just starting out, the journey can be rewarding and transformative, offering the potential for financial growth and stability. Ultimately, the decision to invest in real estate should fit your personal financial goals, risk tolerance, and your lifestyle. By taking the time to carefully evaluate your options and develop a solid investment strategy, you can succeed in the dynamic and ever-changing world of real estate investing.
Success is built on continuous learning and smart execution. If this video gave you valuable insights, show some love with a like, subscribe, and tap the bell so you never miss out. And now, let's hear from you. What's one strategy from today's video that you'll put into action? Comment below. Join our community absolutely free to learn even more on this topic. Don't stop here. There's even more free value waiting for you. Click the link now.